Welcome back, everybody. Unlike what you've been hearing in the news, I am still alive. This thesis is available for free on my Patreon. The link is in the description. Let's get to it. Block Incorporated is a technology-driven financial services company that provides innovative solutions to empower businesses and individuals in the digital economy. Before we get to Block, let's talk real quick about my hiatus. I was preparing for an interview at an awesome company who shall remain nameless. 6 months later, I looked at this channel and thought about ways to proceed. I thought, what makes me different from other finance YouTube channels? Where do I bring value? Plenty of channels do macro market videos, and that's just not what I love. What I love is evaluating companies. Finding the best companies in the market. Digging deep, what are their hidden secrets? What is the value? What should it be worth today? So that's what I'll focus on in my channel. Company-specific detailed information, deep dives, and valuations. You can download my investment report for free at my Patreon in the link in the description. There is no need to become a member. With that out of the way, let's get into Block. With a wide range of services spanning payments, hardware, software, and financial tools, Block has positioned itself as a key player in the fintech industry. This video aims to provide an analysis of Block's business, market position, opportunities, risks to assist potential investors in making informed decisions, and a DCF valuation. Somehow, I'm recording. How did you sneak in? Okay, she went back to sleep. A company is only as strong as its leaders, so I usually put that near the top. Jack Dorsey was raised in St. Louis, Missouri, and had a modest upbringing. Jack attended New York University, where he came up with the idea of Twitter and then dropped out to pursue his dreams. Twitter was created in 2006 with Jack as its CEO. Square was founded in 2009 when Jack and Jim McKelvey were unable to complete a $2,000 sale on his glass faucets and fittings because he could not accept credit cards. This gave inspiration for the card reader, and the card reader is Square's first product. Now, Block splits their business segments into two categories. Let's start with the boring one, Square. Square has many products such as POS terminals, an online store for sellers, inventory management, banking, which includes Square Credit Card, which is in beta, loans, among others. Square Loans has a unique payback option for small-scale sellers due to their integrations. A fixed percentage of a seller's daily credit card sales can be automatically deducted until the loan is fully repaid. This is a pretty unique service. This allows the payback amount to scale depending on the level of money coming in. It is a method I find unique and very helpful for seasonal companies. The loan has a flat fee instead of recurring interest. Now, Cash App. Cash App is Block's cash maker. Pun intended. Cash App is a peer-to-peer payment app that lets individuals send, receive, and invest money. Investment options include stocks and Bitcoin. You can also do your taxes through Cash App Tax, which is fed data from Cash App. Oh no, charts! Don't worry, I'll keep this quick and to the point. User growth remains consistent and strong. No complaints here. While Cash App revenue growth has slowed since the end of the pandemic, it remains a monster with growth reaccelerating. I'll show that in the next few slides. Transaction volumes skyrocketed during the pandemic, then leveled off as demand was pulled forward. So we are beginning to see growth again in Cash App, with Q2 2023 setting a record of $53 billion in peer-to-peer volume in Cash App. Here's the Q2 results for the whole company. Let's break these down. Here's the last few years. Revenue doubled from 2019 to 2020 and almost doubled again from 2020 to 2021. This was primarily due to the pandemic. Demand got pulled forward. As noted, revenues have stagnated in the last year. This is primarily due to the hangover from the pandemic boom, and we should start to see normalized growth rates going forward, as can be seen in the trailing 12-month numbers. The net income numbers are less than stellar. Let's see what is happening there. While revenue growth has been good, net income has been flat and around zero. With that, we need to dive into expenses. From 2021 to 2022, total expenses jumped from $4.1 billion to $6.4 billion. This is due to money being spent to fuel growth, as well as the acquisition of Afterpay. Afterpay is not an official business segment for Block, but again is a very important topic as it affects the other segments and their finances. Afterpay is a buy now pay later system, and the deal closed in January of 2022. This is one of the reasons why the costs in 2022 were exceptionally high. Now, Afterpay was purchased for $29 billion in an all-stock transaction. Given Block's current $26 billion market cap, one could make an argument, and I would say a good argument, that Block overpaid for Afterpay. Now, merchants are charged a 30-cent flat fee per transaction, plus a variable fee that ranges from 4 to 6%. Installment options lead to an increase in an average order value of 10 to 20% and increased conversion rates. Afterpay is being integrated into both of Square's ecosystems. It is also being offered to all of Square's sellers, greatly expanding Afterpay's customer base and allowing sellers to upsell to customers. In 2022, Afterpay contributed $811 million in revenue and $588 million of gross profit. This is a PS of 36 based on the purchase price. For reference, Block's current PS is 1.34, so I think they grossly overpaid for Afterpay. Now, Block makes money from Afterpay on fees generated from consumer receivables, late fees, and certain affiliate and advertising fees. Now, Afterpay was an expensive acquisition by any measure, but it's a little bit too early to tell if it is deemed to be worth it. I will keep track of the synergies in future reports and keep you up to date. Guess what? We're almost to my DCF. Hey, here's some pandas. You've made it this far. Give yourself a round of applause. Don't forget to like and subscribe. Here's the expense growth in percent. This helps put things into perspective. That's other percent growth in 2022 is mostly one-time Afterpay integration costs. That's why it was almost 200%. So as you can see, spending growth has shrunk significantly this year, only growing 9% on a trailing 12-month basis. Here's a quick look at the debt. Debt is high, but recently has been paid down a bit. As Block focuses more on the bottom line and the balance sheet, I expect this number to improve more in the future. However, even with flat revenues, gross profit continues to grow, but at a slightly slower pace, clocking in at a 27% year-over-year growth in the last quarter. It's not all sunshine and roses, however. Adjusted operating income is an interesting metric. Block recently started tracking the results using this instead of adjusted EBITDA. What's the difference? Adjusted operating income includes expenses related to stock-based compensation and depreciation. It more accurately reflects the value being generated to shareholders. As you can see, Block is paying for its growth with adjusted operating income at about break-even if you normalize it over the past several quarters. Unlike other tech companies, Block is still actively hiring, although the hiring is becoming more strategic, focused, and is slowing down. This expansion does come at a cost. Now, markets are more forward-looking. Block increased their guidance last quarter for adjusted EBITDA this year to $1.5 billion and adjusted operating income to a positive $25 million from a negative $115 million. So what did the market do? They sold off, as expected. The Rule of 40. You might be wondering, what the heck is the Rule of 40? The Rule of 40 is a common metric used by analysts to value tech companies. Block uses the Rule of 40, but on an adjusted operating income basis instead of EBITDA. So basically, the Rule of 40 is the revenue growth rate plus the adjusted operating income margin. Block uses this in each of their business segments to determine its viability and if any adjustments are needed. As can be seen, the extra focus by Block recently on the Rule of 40 makes sense, since the number went sharply negative in 2022. It has rebounded back into the positive in 2023, but is currently shy of the goal of 40. Block operates in a highly competitive fintech industry, where innovation and adaptability are crucial. Key competitors include PayPal, Stripe, and traditional financial institutions entering the digital space. However, Square's competitive suite of services, user-friendly interfaces, integrations, and focus on servicing underserved markets give it a competitive advantage over most competitors in the space. One of the biggest risks, frankly, is the low barrier to entry. The competitive landscape is so intense, with established players and new entrants vying for market share. Failure to innovate and differentiate could hamper Block's growth. Some competitors in the fintech space include Apple Pay, Google Pay, Samsung Pay, Affirm, PayPal, and so on. So now let's switch on over to opportunities and risks. Some of the opportunities are digital payments adoption. The ongoing shift from cash to digital payments represents a significant growth opportunity. Square's user-friendly payment solution caters to businesses transitioning to digital transactions. The continued expansion of Cash App's features and services, such as investing, Bitcoin trading, and banking features, could attract a broader user base and increase engagement. Block's integrated solutions for small businesses, including POS systems, inventory management, and financing, position the company well to serve the evolving needs of this market segment. Block believes that the power of business revolves around multiple different ecosystems serving different audiences, and they are looking for opportunities with the teams to connect them. Most competitors focus only one vertical. Block has 3. The following systems are undergoing integrations: Square and Cash App, payroll and Cash App taxes. Cash App and Square through Afterpay is the biggest focus right now. So what Square is doing is they're going up markets to concentrate on the higher volume and the higher transaction sellers. And these are also the more profitable sellers that require a more diversified solution. Last but not least, Block is expanding globally. Overseas sales are becoming a larger portion of Square's gross profits. Please note that this is for Square only, not Cash App. One of the biggest risks is the regulatory environment. The fintech industry is subject to evolving regulations that could impact Square's operations and growth potential. Regulatory challenges in areas like data privacy, anti-money laundering, and digital currencies could affect the company's performance. And of course, we've discussed competition a couple of times, and it is intense. And there is also a dependence on key personnel. The company's performance is closely tied to the vision and leadership of key individuals, including CEO Jack Dorsey. Any sudden changes in leadership could impact investor confidence. As you can see, Block stock has fallen off a cliff the last few years. Yes, you read that right. Block's share price is less today than it was 5 years ago. It is down 83.6% from its peak during the pandemic boom. Block stock has been hit hard lately due to recession fears and high interest rates. Is Block a value stock, or is it a value trap? Valuing Block is tricky, to say the least. The risks are large, and the competition is fierce. That will play a factor into the DCF model. Now here are some historical numbers so you can see where I derive my DCF estimates from. The green boxes are from Square's reports. The white boxes are calculated rows. I'm issuing Block an ultra high discount rate of 14.8% due to a combination of today's high interest rates and Block's volatility. Notice the beta is at 2.56 in here. That is extremely high. Please note that the higher the discount rate, the lower the valuation. This is a base case model erring on the conservative side, I believe. Assuming the following revenues for the next 10 years, I come to the following DCF valuation. Revenue growth trending down from 26% gradually to 10%, with free cash flow growing to $5.1 billion during that span. I'm assuming a discount rate of 14.8% and a perpetual growth rate of 4%. The perpetual valuation equity value comes out to $28 billion. The multiple valuation equity value comes out to about $34 billion, assuming a 12x multiple. You average those two numbers, and I get a share price of $51.18 as my fair valuation. I created this spreadsheet a few days back, so the upside is actually a bit better today than the 16% I show here. Well, at least she's still asleep. You can download my investment report for free at my Patreon in the link in the description. All I ask for is a like and a subscribe to help my channel come back from the dead. I'm keeping block to below 5% of my portfolio. It will never be a high portion of my stake. I view block as a high risk, high reward stock. So if you don't like the risk, then please don't get into it. Please note that this report is for informational purposes only and should never be considered financial advice. Please consult your financial advisor before making any investment decisions. As always, do your own research. Let me know in the comments below what company should I do next. Thank you, and I'll see you in the next one.